Hi, this is Stock Investor Davis. Let's take a look at Tesla reviewing its 2023 quarter 3 results, followed by looking ahead at its fourth quarter guidance and beyond, and closing with a technical analysis of the stock price. There are chapters below. If you want to skip ahead to a certain section, please like and subscribe. Starting with its income statement, we highlighted the larger changes year over year for the quarter and for the 9-month ended, and indicating in red either an increase or decrease next to each. The report's font is relatively little, therefore let me provide the top takeaways here, which I placed a number next to each discussion point to help follow along. Point 1, its net income pulled back by $1.8 billion for the 9-month period ended 2023 compared to 2022. Its net income going from $8.9 billion to $7 billion in this comparison. Then for the third quarter comparison, we see its net income go from $3.3 billion in 2022 quarter 3 to $1.9 billion in 2023 quarter 3, a difference of $1.4 billion. This pullback in net income is carried to its earnings per share, which has a similar proportional pullback. This leads to the question, what's causing this decline? Point 2, its gross margin sees a similar decline to its net income. For the 9-month ended period 2022, we see a $15 billion in gross margin, but in 2023, we have $13.2 billion. We see a big decline for the third quarter year over year too, going from $5.4 billion in 2022 to $4.2 billion in 2023. We now know the decline is primarily due to its sales process because of the $2 billion decline in net income before taxes. $1.8 billion is accounted for in its first phase of its operations. We'll look at this further in our next two slides. The point 3, a quick summary of the larger changes during its 9-month period ended 2023 compared to 2022. Total revenue is up $14.5 billion. Total cost of revenue is up $16.3 billion. Pausing here, these two figures give us the indication that the problem is with its cost of revenues outpacing its revenue. But again, we'll dig into these two categories further shortly. Continuing our list of larger changes, we see its operating expenses are up $1 billion, with a noticeable jump in its research and development costs in its third quarter, going from $733 million in 2022 quarter 3 to now $1.2 billion in 2023's quarter 3, and also its interest and other income increasing by nearly $1 billion, driven by higher interest earned on cash equivalents. Now let's dig further into its cost of revenues to see if that's where its problem lies. Digging into its cost of revenues and gross margin percentages, we actually find out that it's not the cost of revenue that's causing the problem at all. Similar to the previous slide, because the font is rather small, I'm going to provide the top takeaways here, placing a number next to each discussion point to help follow along. Point 1, within its notes section of cost of automotive sales revenue, it states the increase is in line with the change in deliveries year over year. We are able to confirm this by looking at Tesla's deliveries year over year and seeing it has increased nearly 46%, going from roughly 900,000 deliveries in 2022 to now 1.3 million deliveries in 2023 for its first 9 months. See the graphic in the middle of the slide. We can now compare this to what it shows as the change in its automotive cost of revenues in the upper right corner. It shows the cost of automotive sales have gone up 40%, meaning it actually improved its cost of sales. Yet we see the gross margin for automotive shrinking to 19.7% so far this year, compared to 29.6% last year. We see a similar story in its current quarter's margin in auto sales, falling from 27.9% to 18.7% year over year. Moving to point 2, our second highlighted note states the decrease in its automotive gross margin is due to a lower average selling price on its vehicles. We ran the numbers dividing total deliveries by total automotive revenue, finding indeed the average revenue per car has dropped by roughly $9.2 thousand from $55.2 thousand in 2022 to now $46,000 in 2023. We see a similar drop in revenue per car in its quarter 3 year-over-year comparison. Also, it's worth noting that Tesla previously announced a strategic plan of lowering its prices in order to gain market share. So while this drop is sizable, it is part of its plan. We'll continue monitoring this item over time. Before transitioning to its revenue, point 3 shows a big improvement to its energy generation and storage gross margin, going from 5% in 2022 to now 18%, driven by an improvement in its mega pack, lower its average cost per megawatt hour. While this revenue stream is small, making up roughly 6% of total revenue, it has grown 77% in the past year when comparing its first 9 months in 2022 to now 2023. If it can continue at this pace for a few years, it will be worth highlighting each earnings report. But let's now pivot to its revenue to see what the company has to report. Next, dissecting its revenue, I've highlighted the noteworthy points and numbered the points of discussion to follow along. First point is its automotive sales, going from $50.1 billion in 2022 to now $60.8 billion in 2023, a 21% increase. This is driven by an increase in deliveries, primarily of its models 3 and Y. It's worth mentioning that again, it mentions a lower average selling price on vehicles due to a price reductions year over year. Also, we see a smaller revenue increase in its year-over-year third quarter, only increasing by 5% from $18.7 billion to $19.6 billion. Second point is its services revenue increasing 40% from $4.4 billion to $6.1 billion, driven by increases in sales volume and its paid supercharging and insurance revenue. We see similar increases in its year-over-year third quarter, increasing 32% from $1.6 billion to $2.2 billion. Then, third point is its energy generation and storage increasing 77% from $2.6 billion to $4.6 billion due to its increase in megapack deployments. We see similar increases in its year-over-year third quarter, increasing 40% from $1.1 billion to $1.6 billion. Let's now shift to a timeline of its margins over time. Looking at its margins over time, we have highlighted its gross margin percentage and its operating margin percentage for the past 5 quarters, seeing a consistent decline of both. Focusing on its gross margin, point 1, we see it appears to be hitting the bottom potentially at 18% today. Again, slowly declining from 25% in quarter 3 of 2022 to 24% in quarter 4 of 2022, and then 19% in 2023's first quarter, then roughly 18% in the second and third quarter of 2023. Next, point 2, its operating margin. We see it continually declining as we search for the bottom, going from 17% in quarter 3 of 2022 to 16% in the fourth quarter of 2022, a big drop to 11% in the first quarter of 2023, then under 10% in the second quarter of 2023, and now it's less than 8% in this third quarter. Switching to the balance sheet, the points and changes worth mentioning include its current ratio being above 1. Further, its cash balance of $26.1 billion is nearly enough to cover all of its current liabilities of $26.6 billion. This large amount of cash is intended to help the company expand its capital expenditures, which we will dig into later. Otherwise, notable increases include nearly $5 billion more in cash, $3 billion more in inventory, $6 billion in property, plant, and equipment, $2 billion more in other non-current assets, $3 billion more in other long-term liabilities, and $14 billion in stockholders' equity. None of these are a cause for concern to me as the business continues to grow and expand. Pivoting to its cash flow statement, we have highlighted the larger fluctuations between 9-month periods in 2022 to 2023, indicating a positive or negative cash increase in red. Breaking down the report by activity, we find its operating activities net cash decline from $11.4 billion to $8.9 billion, primarily due to its net income declining about $1.8 billion and its accounts payable spend increasing by $4.6 billion. This is partially offset by its inventory spent decreasing $2.5 billion. Next, its investing activities, adding nearly $5 billion in cash spent, primarily due to the company purchasing investments by an additional $11.7 billion and purchasing an additional $1.3 billion in property and equipment. This is offset by nearly $9 billion in cash coming in from proceeds from its maturity investments. Lastly, its financing activities increasing nearly $4.7 billion, largely due to added cash from issuing $2.5 billion in debt and decreasing spending on current debt by $2.1 billion. Let's now look ahead. Management has provided some insight into what's ahead for Tesla. A couple points to note here, which we will dig into further. First, management confirms that it continues to grow production with its 50% continual annual growth rate target. It mentions a slight hedge that this rate may go faster or slower in the years ahead, but that for 2023, it expects to remain ahead of its 50% growth rate with around 1.8 million vehicles this year. Also mentioning its Cybertruck remains on track for delivery later this year. Let's dig into these pieces of guidance further. Starting with the expected 1.8 million vehicles for 2023, we can calculate that its current totals for the year are roughly 1.35 million vehicles produced and 1.32 million vehicles delivered, which allows us to project the company's fourth quarter expectations to produce and deliver roughly 450 to 480,000 vehicles. If this result occurs, it is fairly similar to its second quarter of 2023. In terms of growth year over year, this is roughly 26%. And for quarter over quarter, it's about 7%. Timing is a factor for the quarter over quarter. Some other items worth noting here include its growth in its other areas of operation, including its electric energy storage deployed, increasing 90% year over year, and its Tesla locations, mobile service fleet, supercharger stations, and supercharger connectors, each growing between 20 and 31% year over year, all at a steady increase over each quarter. All appears to be positive. Here we have a few points that continue the guidance relating to its Cybertruck. At the top, we have the Cybertruck and Tesla Semi are both in pilot production, with the Tesla Semi being produced in Nevada. The second clip tells us that the company expects to spend an additional $2.5 billion in the fourth quarter, calculated by taking its capex spend so far, which is roughly $6.5 billion, subtracting from the $9 billion expected. Additionally, it expects to spend between $7 and $9 billion for the next 2 years in order to help build out its facilities. The last note mentions that along with its production facilities, it's working on expanding its services and charging locations, which, after other auto manufacturers announced adoption of the North American Charging Standard, it must correspondingly expand its network to meet customer demand. Switching to a couple graphs, Tesla shares for comparison is its year-over-year revenue growth and operating margin compared to the auto industry and the S&P 500. We see on the left that while its revenue growth is shrinking by percentage, it's more than double when compared to the S&P 500 and the auto industry at slightly below 30%. Then on the right side, we see its operating margin has pulled back below the S&P 500, but remains ahead of the auto industry. I do anticipate these trends continuing based on what we reviewed and management sentiment. Moving to the analysts, as of today, 11/8, they are projecting $24 billion in revenue, which to me seems low, considering it made $23.3 billion in this third quarter, and we calculate it will produce and sell about 7% more in its fourth quarter. Adding 7% to its quarter three revenue, it's closer to $25 billion as a projection. This is then carried out for the full year projection too. Then analysts projected 71 cents for earnings per share, which seems reasonable based on quarter three results and quarter four increased expectations. We'll see how it plays out. Wrapping up with the technical analysis, Tesla currently at $220. It broke below its uptrend noted in January 2023 after reporting earnings and appears to have found support near 214. The next support point being 186. I like the price. Thank you for watching. Please like and subscribe.